to welcome Dr.Donghyun from the Asian Development Bank. Now, Dr. Pang is a principal economist in the Asian Development Bank, and today he would like to present the paper about the price of the greenness, some evidence from the green bond market. So you will have around 40 to 50 minutes to present, and then you will have the Q&A sessions. Thank you so much, all. The floor is yours now.
Thank you, JJ. Thanks to the Thammasat University for organizing the seminar. Okay, so the paper I will be presenting today is a joint paper together with my colleague from ADB, Dr. Donghyun, and Professor Seokchun at Yonsei University in Korea. It's a paper about the green bond market, and more specifically, the pricing of green bonds via green market. So let me just briefly give you the structure or outline of my presentation. I will begin by motivating our paper, and then secondly, I will talk briefly about the actual characteristics of the green bond market and the conceptual definition of the green bond market, and then I'll talk about the empirical approach or empirical methodology that we use, as well as the main findings that emerge from our empirical analysis before I conclude the paper. Okay, so I think let me just briefly talk about green bonds. I think most of you here do not have a finance background, but the concept is simple enough. Green bonds are bonds that finance bonds whose proceeds, right? The proceeds from green bonds are used to finance environmentally friendly or green projects. And I think one thing we really have to emphasize about green bonds, and this is really what differentiates green bonds from conventional bonds, is that like conventional bonds, of course, they have a financial risk, right? For example, default risk. Credit rating agencies assess a firm's default risk, and of course, the higher the default risk, the higher the premium, right? And that's reflected in a higher yield, right? So like conventional bonds, green bonds have this element of financial risk. But in addition, green bonds have an additional key dimension, which is environmental benefit. And this environmental benefit, and this is also an important point, unlike the financial risk, it's much more difficult to price into the yield of the green bond. And of course, because in general, the world and Asia, right, Asia as well, and ADB as well, by the way, paying more attention to the environment and protecting the environment. Of course, that means it is important to find ways to finance green investments. That's why green bonds have been emerging as a new financial instrument to finance these kinds of green investments. By the way, the first green bond, right, was issued by a European Investment Bank in 2007, the Climate Awareness Bond. And this is a milestone event, the introduction of the Green Bond Principles, or GBP, by the International Capital Market Association in 2014. This is a milestone event, and it's an event that catalyzed, that really promoted the development of the green bond market. These green bond principles, it has to be emphasized, are a voluntary process, a voluntary guideline that provide general guidelines about certification of green bonds. And then, of course, they provide the issuers of green bonds about the key elements, with guidance about key elements about issuing green bonds. Now, if you look at this growth of the green bond market, it has been quite explosive. There has been very rapid growth, to the extent that by 2017, issuance right? Not the total size, but issuance of green bonds worldwide reached over $155 billion, so which is quite a substantial amount. And then if you look at the leading countries in this green bond market, it's the US, European Union, and China. They are the leading countries in terms of issuing green bonds. These are the country breakdown. And if you look at the share of green bonds by government and supranational and corporate, you can see that corporates dominate. In other words, corporates account for about a little less than 2/3, right, of the green bond market, and about 1/3 of this corporate, right, is actually commercial banks, right? So corporates dominate the green bond market, and thank you. And within corporates, commercial players are an especially important player, accounting for about 1/3 of this green area right here. Okay. Now, we have just seen that green bonds, explosive growth, growing very rapidly. But still, if you look at their relative size, it's quite small. It still remains quite small. It's less than 2% of global bond issuance in 2016. So conventional bonds, over 98%. Green bonds, less than 2%. In other words, there's a long way to go. So then the next obvious question becomes, what are some key challenges to further developing this green bond market? Well, one is that there is a GBP, green bond principles. There's also climate bond standards. And by the way, I forgot to say this, but there are also other standards. There's an ASEAN green bond standards, right? ASEAN GBS. There's also an EU, European Union GBS green bond standard. And China has its own green bond standards. So what you can see is there's a lack of a universally accepted definition or standard of green bond. Of course, that is, of course, a barrier to the development of the green bond market. In other words, if we have a more widely accepted standard, that would help to promote the further development of the green bond market. Now, related to this lack of a widely accepted green bond standard is that the pricing mechanism for green bonds is still relatively unclear, right? Well, let's use an analogy, because for conventional bonds, as I said earlier, you have credit rating agencies who assess default risk, right, of a particular firm, of a particular issuer. If the default risk is high, of course the risk premium is high, and that is reflected in higher yields. And you have well-established credit rating agencies such as Moody's and S&P's and Fitch and others that assess, right, the bond issuing firm's default risk. But the problem with green bonds is we do not have such a well-defined evaluator of environmental benefit, if you will. So we do not have something like credit rating agencies that assess financial risk. We do not have a similar mechanism for assessing environmental benefit. In other words, there's no Moody's or no S&P or no Fitch that assess environmental benefit. Of course, if there were such a rating agency, if there was such a assessment agency or information agency, that would make it much easier for this environmental benefit to be priced into the price of green bonds. Okay. So what do we try to do in this particular paper? Let's go into the analysis now. Well, first of all, we want to see if there are any differences, significant differences in yields between green bonds and conventional bonds, number one. And number two, we want to see whether greenness, and let me be more specific here. By greenness, we mean indicator of greenness, right, or index of greenness. Whether indicator of greenness contributes to the yield difference between conventional bond and the green bond. And then, based on our analysis, we do want to discuss some possible policy options to further promote green bond markets. And I think, again, it's important to note what is the value added or original contribution of our study to the literature. And it is this, that our paper is the first paper that tries to empirically incorporate this greenness indicator, and then I will explain what greenness indicators we use later, so you have a better idea. We try to empirically assess the effect of greenness indicator in the pricing of green bonds. Okay, so what are some key characteristics of the green bond markets? Well, as I said earlier, green bonds are like conventional bonds in many ways, but unlike conventional bonds, the proceeds from green bonds are used to finance green projects, green investment projects, or environmentally sustainable investment projects. That's the big social benefit from green bonds, but they're also generally less liquid. They're more illiquid. In other words, it's much more difficult to buy and sell because there's much less active trading of green bonds. So relative to conventional bond markets, green bond markets, much less liquid. And then also, because investors do not have a clear idea about whether a green bond is truly a green bond, whether the proceeds from green bonds are actually used to finance green investment projects, they have a very high information costs, the investors, those who want to invest in green bonds. So what are some of the, conceptually, what are some of the key players in the green bond markets? First of all, you have issuers, right? Companies and governments and the other entities that issue green bonds. First of all, because you have to prove your greenness, you have to provide certification that you're green, issuers of green bonds incur quite high costs to become green and also to maintain their greenness. On the positive side, of course, it helps to boost their green reputation or environmental reputation, and for green bond issuers, it also helps to bring in long-term investors who have mandates, who have environmental mandates, who have social mandates, who have governance mandates, right? ESG mandates, right? And the other ethically motivated long-term investors, especially long-term institutional investors, thereby helping to diversify their institutional base. And on top of this, a paper that was published just this year from Hong Kong University by Professor Dragon Tang, according to his research, when a company issues green bonds, quite immediately its stock prices go up and its stock tradings become more liquid, and therefore the firm value goes up. So it also helps to boost firm value and thereby shareholder value, according to very recent empirical research. So what are the second type of key players? Of course, there are the investors. Many of these investors have mandates, right? Have an obligation to invest in green projects. So for them, green bonds are a good thing to buy, right? Because by buying green bonds, that can help them fulfill their green investment mandates. Of course, these kinds of green investment mandates are more widespread, more well-developed in advanced countries, especially in Western Europe, right? Because it's a very the environmental issue is very strong, right? Very highly prioritized. And because they are long-term investors, they tend to be relatively less sensitive to reforms. And as I said earlier, they face very high information costs of assessing whether green bonds are truly green bonds or to what extent green bonds are green bonds, right? And then we have a third group of players who are the facilitating agencies. Like conventional bonds, green bonds also have underwriters and rating agencies. But again, rating agencies, they assess financial risk because by assessing default risk, and then that leads to premiums, right? Risk premiums, and that's priced in, right, into the yield of the bond, right? But as I said earlier, for greenness, we need one additional, because green bonds is a hybrid product. It's a combined product that combines financial risk as well as environmental risk. We need something more. we need another additional layer of facilitating agency for green bonds. And these are like external reviewers, index label, certification, these kinds of agents that provide information about greenness, right? Greenness information providers. So this is a very simple diagram, but it really helps us to understand the pricing mechanism in green bonds, right? In green bond prices. On the one hand, greenness helps to reduce, right? It generates a discount, right? It helps to reduce the yields of green bonds. But on the other hand, lack of liquidity, right, which I noted earlier, that it's after you buy a green bond, it's much more difficult to buy and sell these green bonds. Of course, that means investors will demand a premium, right, for buying green bonds, so that will lead to a premium, right, a higher yield on green bonds. So here, because greenness, because green bonds are green, it helps investors fulfill greenness mandates, and they're ethical investors. For example, ethical investors, it helps to fulfill their obligation for green investment and so forth. That helps to reduce, that increases the demand, right, for green bonds, helps to reduce the yield on green bonds. On the other hand, because green bond markets tend to be less liquid than conventional bond, investors will demand a premium, which pushes up, right, green bond yields. Okay, so what is the existing evidence about green bond pricing? And most of these studies, as you will note, are quite recent. And then there are two basic, the evidence of green bond premium, whether there's a green bond premium, whether there's a green bond discount, or whether there's no difference between price of green bonds and the conventional bonds. The evidence on that is mixed, decidedly mixed. One group of studies, right, finds that there is a green bond discount, if you will. In other words, the yield is lower than comparable conventional bonds. On the other hand, other studies, the second strand of studies, find, in fact, there's no difference, no statistical difference in the yield between green bonds and conventional bonds. So these are the existing studies. However, it should be noted, one big shortfall in the literature, if you will, is that none of the existing studies examine the effect of greenness indicator in green bond pricing. Now, and that is, of course, what we tried to add in this analysis in our paper. Now, let's go into our own empirical analysis. We collect all data on all green bonds issued between 2000 and 2017 from Bloomberg, right, up to the end of 2017. And because we use Bloomberg, and Bloomberg, the database is a green bond function, all of our green bond data are compliant, already compliant with the green bond principles, okay? And then we also get other data, such as pricing data, bid yield, ask yield, such as basic bond information, such as issuer, credit rating agency, credit rating, issue amount, maturity time, currency of denomination, and so forth, as well as the key dimensions of the bond structure, such as seniority, rank, and option clause, and so forth. All of this we get from Bloomberg. Now, let me briefly describe, let me spend some time describing how we construct our sample. So what we do is, first of all, we look for green bonds, and after we find those green bonds, right, we identify the green bonds, we try to look for conventional bonds that match those green bonds that we find. Okay, so we are trying to identify pairs of green bonds and conventional bonds. So in particular, to be more specific, we try to look for conventional bonds, right, that have the same issuer, same credit rating, same maturity time, same currency of denomination, and same bond structure characteristics as the green bond. And that when we do that, we were able to construct a database of 60 green bond and match conventional bond pairs. In other words, conventional bonds with very similar characteristics to the green bonds, we were able to identify 60 such pairs of green bonds and conventional bonds. Of course, after the green bond and conventional bonds are issued, of course, then there's a time series, right? In other words, we look at their price the next month, and then the next month. If they're issued in January, for example, we look at their price in February and March and so forth. Right? If we use we are using monthly bond yield, and of course for each pair, the time series will be different, right? There's no reason they have to be the same. So what we get is an unbalanced panel, right? Unbalanced panel data of 1,365 bond month observations. So these are the descriptive statistics of our sample. This is the ask yield for the green bond and ask yield for the matched conventional bond. Bid yield for the green bond, bid yield for the matched conventional bond coupon, and likewise for coupon and the coupon rate and the amount issued. So no statistical difference for ask yield and bid yield. And by the way, I think one thing I would like to highlight is that in general, as I said earlier, green bonds issuances are smaller, significantly smaller than the issuance of conventional bonds. Okay, so green bond market still relatively small, and green bond markets also still relatively illiquid, although they are developing rapidly. So this is the empirical methodology that we used, right? So the first step is to obtain the yield, right? Yield spread between green bond and its matched conventional bond. And as I said earlier, conventional bond and green bond are two different bond markets, right? Of course, they share many similar characteristics, but they're fundamentally different assets because green bonds are a hybrid product that combines financial risk and environmental benefit. Conventional bond only has financial risks and financial dimensions, right? Unlike green bonds, which are a hybrid product. So what that means is there's a significant, well, we saw that the green bonds are generally much smaller green bond issuance than conventional bonds. But on top of that, and perhaps more importantly, green bond market tends to be less liquid than conventional bonds. Therefore, when we look at this yield spread between green bond and its matched conventional bond, what we want to look at is the effect of greenness. So we want to separate out effects or characteristics that are not related to greenness, especially liquidity. So we want to adjust for liquidity because we want to focus on the role of greenness in green bond pricing. So to do that, to separate out the liquidity factor, the yield spread, we regress that on a proxy of liquidity, which is the bid-ask spread. And the residual from that regression we define as the green bond premium. Because, why? Because it's a premium on greenness. It's not a premium on liquidity. It's not a premium on other characteristics of the green bond market. It's a premium on greenness. Okay. Of course, that residual may very well contain other factors other than greenness. We acknowledge that, but even so, if we separate out liquidity as we do, then at least this premium is a much more accurate, much better measure of this role of greenness or green bond premium. Okay, therefore, as I just said earlier, this liquidity-adjusted green bond premium, that's the part of the yield which cannot be explained by liquidity, and therefore which can be explained by other factors, of course, in particular, can be explained by greenness. Therefore, to repeat it, much better captures, reflects the role of greenness. Okay, so we estimate this green bond premium through two different methods, OLS as well as fixed effect GLS, and then these are, first of all, this is the liquidity adjusted yield spread between green bond and it's matched the conventional bond, right? So this is what we do. Dependent variable is the ask yield spread, and we regress that on liquidity, right? Which we proxy with the bid-ask spread, and these are the results we get. And again, the residual is the green bond premium. So if you look at the green bond premium on average, this is the premium estimated by OLS, this is the premium estimated by fixed effect GLS. You can see right away, just eyeballing it, that there's no statistical differences, right? They cluster around zero for both OLS estimated premium and GLS estimated premium. It's a very small, 0.4 bips, statistically not significant. So you might say, oh, there's no green bond premium, so this means our study, the study that I did with Grace, is much closer, is consistent with the second strand of studies, right? The earlier existing studies I talked about, one strand finds a green bond discount, the other strand of studies find no significant difference between green bonds and conventional bonds. So, oh, these guys, our study, Park and Tian and him, their evidence is similar to the second strand of studies. That is certainly true. And then what we do here further is that we look at the determinants of the green bond premium, right? And actually, this is the descriptive statistics. So the key variables here are, and this is really what we add to the literature. This is how we extend this green bond pricing literature. This is an independent reviewer. It's a measure of greenness. It's a greenness indicator, if you will, that I talked about earlier. This is CPI certification, certified by Climate Bond Initiative. So this is another index, right? Indicator of greenness. This is, so which we simply call greenness in our paper, right? And these are the control variables, maturity squared, right? Because there's possible non-linearities there. The ask yield and currency of denomination, euro-denominated green bonds, US dollar-denominated green bonds. This is financial green bonds issued by financial companies, green bonds issued by utilities. This is the issue amount. This is the issue amount squared. This is credit ratings, right? AA, single A, and triple B. So we throw in the standard control variables, but unlike the existing studies, we also add measures of greenness. And these are the results that we get. These are the results that we get. Of course, we get some results from the control variables, but I really want you to focus on this one. When we regress, right, the green bond premium estimated by OLS method, what is the impact of these two greenness indicators or greenness indices? So for an independent reviewer, it seems that this independent reviewer reduces, right, the green bond yield. In other words, it produces a discount of 6.6 bips. Now, if another greenness indicator, the CBI certification, that produces an even bigger discount. It reduces the green bond yield even further relative to matched conventional bonds. And that makes perfect intuitive sense. Why? Because all of our data, by the way, as I said earlier, all the 60 pairs are comply with green bond principle, which is a voluntary process. But in addition, some of those green bond issuers, they go and get an independent review, which is costly, by the way. So, but for CBI certification, that's a higher level of greenness, more rigorous level of greenness. Why? Because CPI certification already requires independent review. So green bond principles, all our data, right, 60 pair, they comply with green bond principles. But some of them get independent review, higher level of greenness. And some of them even get CPI certification, which is an even higher level of greenness. So it's not surprising that CPI certification produces a bigger discount than independent review. But the broader point here is that both of these greenness indicators, yes, they do reduce the green bond premium. In other words, they produce a discount. In other words, they make it less costly for green bond issuers, right, to issue green bonds. So this is the result for a premium. Green bond premium estimated by OLS, when that is the dependent variable. And this is the results we get when the premium, our green bond premium is estimated by GLS, and qualitatively they're the same. And again, both are significant. That's the key result. And the interesting secondary result is that the CBI CT certification, which is a higher, more rigorous level of greenness, that produces a bigger discount, right, on green bond yields relative to matched conventional bond yields. That produces a bigger discount than this independent review, which is a lower level of greenness, if you will. So summary and conclusion is that on average, if you go back to the two slides, right, the two mountain slides, on average, right, there's statistically no significant difference, right, in the yield between conventional bonds and matched green bonds. But both, when we try to assess, empirically investigate the effect of greenness indicator on green bond yields, we find that indeed they matter. Indeed, they are important. Indeed, both the independent reviewer and the certification by Climate Bond Initiative, they tend to reduce, right? They tend to produce a discount in the green bond yields. In other words, they make it less costly for green bond issuers to issue green bonds, reduces the financial cost. So that really highlights, if you will, the importance of green indicators, green indices, or green standards, if you will, like external review and CBI certification in the further development of green bond markets by boosting investor confidence, by increasing their information. It helps to reduce, right, the information asymmetry, which we talked about, and it thereby helps to better price. It helps the pricing mechanism to work better, and thereby it really helps to promote the further development of green bond markets. By the way, on a closing note, I mean, just as a discussion, further discussion points are these two issues. Thus, going green, in other words, when investors buy green bonds, or from the viewpoint of issuers, when companies or government issue green bonds, right? Do they have to pay a higher cost? Do green bonds issuers have to pay a higher cost, or do investors who buy green bonds, do they have to sacrifice some yield? Is that necessarily the case, right? That's something to think about, because if you think about it, these are environmental benefits. It's a public good. So why should I be punished because I'm buying a green bond? Or why should I incur higher costs, certification costs and other costs when I issue green bonds, right? That's an issue to certainly think about. But if you think about it, the problem here, the underlying problem is information asymmetry, right? So as the market develops further, green bond market develops further, as it becomes thicker, deeper, more liquid, and more broader, the sense is that our feeling is that no, this will become less of a problem, and in fact, conventional bond issuers, right? In fact, they're the ones that will have to incur higher costs because these kinds of environmental benefits, right, will be priced in more, will be more reflected, right, in asset prices, including green bond prices. So there's a cause for optimism as the green bond markets develop further. This kind of issue will become less of a problem. And secondly, this is a broader issue. How can we price in? We just talked about as the markets develop further, these kinds of environmental benefits will be priced in, so that will make a lower yield for investors and higher cost for issuers less of a problem going forward. Okay, that's fine, but that will take some time, right? But in the meantime, in the more short term, what can we do? What can governments do? What can private sector do so that this kind of positive externality from green bonds can be better monetized, even in the short term? So, for example, we did a seminar at World Bank in KL in Malaysia yesterday, and according to what we heard, the Malaysian government is being very active, proactive in providing subsidies, right, and other support to further promote the development of green bond markets. And then conversely, we also heard a few weeks ago that in Thailand, right, the government is trying to impose penalties on green bond issuers, those who issue green bonds that do not remain green, like a penalty for green bond issuers who fail to maintain their greenness. But our feeling is that kind of discouragement, right, is much less productive, because once you start imposing these kinds of penalties, green bond issuers already face high costs to begin with, and then when the government starts imposing penalties, you're not green after 3 years, not green after 5 years, that will really make them hesitate even more about issuing green bonds in the first place. So our feeling is it's probably much more productive and efficient to encourage issuance of green bonds, to provide some positive incentives rather than these kinds of negative incentives. So that's it.
So thank you so much, thank you so much, Tom, for your presentations. So I will open for the floor for the discussions. Please.
Thank you very much for your very, very interesting talk, right? And it is new to me for the green bond, and I'm not financial people. But at the moment, I'm developing Thailand and the world towards sustainability. I would like to ask, at the moment, green bond regarding to the world dialogue, how far it goes now, or it's just initial stage? Thank you.
So as I said earlier, in terms of the amount, right? So in terms of the growth, I think it's best that I show you this graph. It's growing very rapidly, right? As you can see. So this is in 2017, this is the issuance of new bonds. So 156 billion US dollar worth of new green bonds were issued in 2017, right? So it's and this is from almost nothing, right? As recently as 2012. So there has been a very rapid growth. But at the same time, as I said earlier, we still have a long way to go, because in 2016, right, just 2 years ago, green bonds accounted for less than 2% of all bonds. So there has been a lot of growth, rapid growth, very rapid growth, but the total amount relative amount still remains fairly small, which means there's still a lot of scope for further development, growth of the green bond market.
And Tom, I have some question for your clarifications. So I'm not quite sure that you talk about the bond standard, that right? And you say that the standard of the green bond is totally different, right, among the Asian countries and maybe in China, and this might be an obstacle to promote the green bond market. Could you kindly clarify this kind of point, that how the standard, the difference make the countries, or make the regions is rather difficult to develop the green bond market?
Okay, let me answer that question. So as I said earlier, we have green bond principles, right? And we also have climate bond standards, CBS, right, by Climate Bond Initiative. On top of that, these are two global standards. We have some regional and country standards like ASEAN Green Bond Standard and then European Union Green Bond Standards. And China, right, has its own national, if you will, green bond standards. Now, for example, if for example, hypothetically, China's green bond standard is not as rigorous as, let's say, the GDP, global, the GDP, right? This one, this green bond principles. Then, of course, that would make it very difficult to integrate the Chinese green bond market into the global green bond market, because then, for example, institute, say a European, say a German institutional investor, right? They're interested in investing in Chinese green bonds, right? But then the Chinese green bonds are defined as green by the Chinese bond standard, right? Rather than the green bond principles, right? Then of course that would make it very difficult for them to certify, right? That these Chinese bonds are in effect green bonds. So in short, it really is a barrier to the integration of the cross-border integration of green bond markets. Is that? Yeah, go. Yeah. I think Ray said something further.
Thank you, Gigi, for the question. Actually, it's a very good question. I think we should emphasize that when we talk about this page. The basic obstacle for like a common definition in the products is like this. For example, in the financial markets, right, stock markets, bond market, right, the structure or the features of the products, the instruments is standard. So, for example, stocks, right, all the stocks you don't need to care about whether this stock will have some fundamental issues, whether this stock entitled some of the assets, some stocks do not, right? So basically, in terms of the structure of the financial instrument, there is common understanding about what is a stock, what is a bond, and then the only difference is actually the underlying cash flows behind, so support these instruments. So on that end, the structure of the product is okay. But for this green bond market, if the investors and the issuers, they don't have a consistent common understanding about whether this is green or whether this is a green bond at all. So actually that product feature is not clear. So when the issuers wanted to issue some green bonds, and then what makes this green is not well clearly defined, or investors have a different understanding about what I mean. It's a green bond, right? It will really hamper the trading and the valuation of the products. So in the first place, because this green bond is a new, it's a different instrument. It's a hybrid instrument of common conventional financial cash flow and environmental benefits or environmental considerations. So actually, we need to clearly define what makes it green. So common understanding is important for the market.
Thank you. So I'm not sure that Tom, if later we talk about the certifications that Dr. Chuan, or Dr. Chu talk about, you have two later indicators, and these two indicators is already worldwide uses, or this is only indicated to indicator that you pick from this empirical study, because this will later have the indication for the policy recommendations that people can look at this two later indicator when we would like to promote the green bonds, something like that. Could you kindly comment on this?
Okay, you mean the two indicators are CBI certification and independent review, right? So okay, so this is the what's happening. As I said earlier, let me try to explain a little more clearly. All of our 60 pairs, right? 60 pairs are green and matched conventional bonds
they comply with GDP, green bond principles, because we get the data from Bloomberg, right? And Bloomberg defines these green bonds as complying with the green bond principles already. But on top of this, some of these 60 pairs or more, some of the green bonds, right, go for independent review. Why do they incur such costs? Because they want to get a higher certification, more rigorous certification, and of course there are benefits. Of course, it's costly, but it has benefits too. And then the fact that it does have benefits too, our evidence supports that, right? So they incur higher costs in trying to prove a higher level of greenness, if you will, but they also seem to get some benefits, as in this case. On top of that, CBI certification, as I said earlier, is an even higher level of greenness, more rigorous test of greenness or proof of greenness, if you will, because CBI certification already requires an independent review. So independent review is kind of a subset, right, of a CBI certification. So it's an increasing level of rigor. So what we do is, on average, I think, okay, let me explain further. On average, there seems to be no difference, right? The two mountain figures, right? That I showed you. It's an important one, so let me just do it again. Where is it? This one, right? So on average, right? There's no statistical difference between the yields of green bonds, and they're matched, right? Conventional bonds, right? But of course, that's just on average, right? There's going to be cross-sectional variation, right? In other words, for some pairs, there's going to be a significant premium, and some pairs, it's going to be some discount on some pairs, right? So for some pairs of conventional bonds and green bonds, there's going to be no significant difference. So we want to look at what is driving those differences. You see what I'm saying? So that's why we run this additional regression, right? And that is what we try to do. But of course, existing studies, they already looked at the effect of these control variables. So what we add to the literature and analysis, we want to see if these indicators of greenness, they help to explain this cross-sectional variation between bond premium. And the answer seems to be yes. It seems to reduce, right, the green bond yield relative to conventional bond yield. In other words, it seems to reduce the financial cost of issuing green bonds. So it's not so much in response, more direct response to your question. It's not so much whether independent review or CPI certification are global or anything like that. These are well established mechanism, both and the costs are quite high, I have to say. So when a company goes through the trouble of getting an independent review, right? It's not a trivial decision, right? It's a costly decision. It's an investment that they're making. But these kinds of independent reviewing process is quite well established and objective. And CBI certification, right, is even more well established and more objective measure of greenness. GDP and CBS, these are the global standards, not so much the independent review, CBI certification, which are higher levels of rigor, more rigorous definition of greenness, or more rigorous proof of greenness.
Yeah, and then this question is also a good one. So basically, I have to say that these two indicators is just some kind of rough proxy. But the reason why we wanted to do this test is actually, as we already explained. In this green bond market, right, investors not only faces some information about the financial risk, right, they also face more severely information asymmetry regarding the environmental benefits of the green bonds. And then basically, this kind of indicator or information provider, so they help to mitigate the information asymmetry on greenness in the bond market. And then this kind of indicator, we cannot say, right, that this is some kind of standard score or things. There is no such thing, unfortunately. But we believe some similar mechanism can help to mitigate the information asymmetry on greenness in the entire market. So if you can imagine, if the green bond market eventually establish some kind of global recognition, well, on greenness, so some rating agency or some scores can be used, commonly used to justify whether this one is green or not, or whether this one is a true green. It's like credit rating agencies, well, Moody's, Standard & Poor's, so widely acknowledged. And then this significantly lowers the information barriers on greenness. So that is what we are trying to see. So some kind of information provider justify whether it's green or not helps in the market.
So I would like to ask, from the NB viewpoint, how you can promote the green bond market. What are the key policies, options that the NDB would like to propose to promote such a green bond?
You know what? This is a very good question, especially for our purposes here today. Grace, can you take the first step at this? ADB already has issued some green bonds, right? So has the World Bank and other supranationals.
Basically, right. This the green bond actually is calling greater awareness. So not only for supranationals and also governments. And then from what we learned, many of the governments is trying to provide some support, to monetize the environmental benefits. I think we also know, right? So many countries provide subsidize some tax privilege and things. So to trying to monetize the benefit of going green. And I think this kind of arrangement and also the increasing awareness of whether these environmental concerns should be reflected in all asset prices will eventually lead to some kind of a market mechanism in pricing environmental impacts of the financial instruments, which will lead to the future development of the green bond markets.
So one thing that some of our colleagues are doing at ADB, in fact, of course, Grace and I are part of the bond market team, but we are more on the research side, right? We also have a operations team that work on the operational aspect of bond market development. So one thing, work, right? One study that they are doing is how providing quite detailed and concrete guidelines, right, for development of bond markets for ASEAN governments. So these kinds of guideline and operational guideline and operational knowledge, I think that ADB is a useful public good, right, that ADB is providing. She's it's a Thai colleague, by the way. I don't, you were at ADB, so you know Noi. Do you know Noi? Do you remember Noi? Yeah. So it's a work that she's doing.
So I think your work has some substantial finding about the true indicators that make the price of or the yield of the green bonds decline. And I think this helps some reference to the asymmetric informations among the investor or among the issuer that would like to issue the green bonds or invest in the green bonds. So as international organizations, you have the idea or you have the policy that try to reduce this kind of asymmetric informations, not only in some particular country, but as Asia as a whole. So ADB has some initiative on that.
Not according to what I know, but basically, you know what? This is a good idea. You know, ADB is I think the Southeast Asia department they are leading some kind of governance score. So they are trying to create some kind of corporate governance standard according to the regional consistent corporate governance scores, so to facilitate investors to understand the governance quality of companies. And then I think your suggestion is a good one. I'm not sure whether there are some work in the process, but it's a good idea if ADB could also provide such public good, so regional consistent scores. But ASEAN already have their regional standard green bond initiative, so I think they may provide some kind of information.
And also, I think this kind of research also, I think, can provide some intellectual, if you will, support for the urgency of developing globally widely accepted, if not universal, green bond standards. I think so. In that way, in that indirect way, I think we're also contributing to this process of further developing, reminding the world of the urgency of developing these kinds of green bond standards, which can help the pricing mechanism like that.
So, other questions?
I would like to ask from your experience, right, when you promote this green bond, what would the investor look for? For example, they look for the return first, or they look for the environmental first?
Yeah, that's a good question, and this is of course a quantitative econometric study. But one of the comments we got at our presentation at World Bank KL yesterday, and it very much echoes what you just said, is well, these kinds of quantitative studies are of course very important, but it's also important to understand the actual mechanics. In other words, the actual motivations of investors, why they buy green bonds, what deters them from buying more green bonds. These kinds of things, I think, more qualitative study, I think, would be a very useful complement to our study. Of course, it also differs by region. For example, in Europe, which has a much higher priority on environment than Asia, although it is also rapidly strengthening in Asia, growing in Asia. Of course, their institutional investors in particular, right, have a much stronger mandate to invest in environmentally friendly financial products, including green bonds.
I would like to add to your question. So basically, it really depends on the mandates. So if the investors, they have a mandate to have to focus certain part of their portfolio to be environmental friendly, right? They don't have any choice. They have to choose among the pool. And then I think within the pool, a normal investment standard will apply. So they will choose the one which offers the best risk-return profile. So that's it.
So, other questions? Okay, if no, I would like to thank Dr.Donghyun and Dr. Chu Tian from the Asian Development Bank to providing us the intellectuals, right, and really interesting topic today. So thank you so much. Yeah.
Thank you, Jane.
Yeah. To go, I would like to ask Paul to give just a special gift for Tom for Yeah, no. Thank you so much, Paul.